Welcome to the Credit Compass, helping you navigate the world of European credit, where we break down the biggest moves in credit markets, macro trends, and fixed income strategies, shaping finance in Europe and the UK. My name is Gordon Kerr, European macro strategist and host. Today, we're talking about a theme that I began 2025 with and has been proving more accurate in ways that I did not expect. That is differentiation, both across the Atlantic between Europe and the US, and within Europe itself. The bond market sell-off in German bunds has caught attention, raising questions about ECB policy shifts and the outlook for European growth. Meanwhile, the dynamics of fixed income versus equities are changing. European bond yields have now surpassed dividend yields on stocks in Europe, creating a major reassessment of investment strategies. And last week, industrial production numbers gave us a fresh lens on where different parts of Europe are heading. So, how should European investors interpret this? Are we at a turning point for European assets? And how does the European story differ from the US? Let's get started. Let's start with what's been happening in German bunds. Over the past few weeks, we've seen a sharp sell-off, sending 10-year bund yields up towards multi-year highs. The key question is, why now? A few things are at play here. Market expectations on the ECB. The European Central Bank has been hinting at further rate cuts, but the bond market seems less and less convinced. Inflation, while cooling, remains sticky in parts of the Eurozone, and economic data are turning slightly more positive. And that's feeding into market skepticism about how aggressively the ECB can cut as inflation approaches target levels. Global rate movements. Let's not forget the US side of the equation. Much like earlier this year when long yields increased in the UK and Europe, they were also moving in the US. Movement in bond markets is not purely isolated to one region. US Treasury yields remain elevated, and that global comparison is exerting upward pressure on the relative level of European yields. And here's the key one: Europe's growth rebound narrative. Some investors are betting that Europe's recession fears were overblown. We agree, and always did. But we were not of the view that the growth picture was looking strongly positive at the beginning of the year. That is changing. While Germany had a rough 2023, services are holding up, industrial activity is stabilizing, and France, Italy, and Spain are seeing more resilience than expected. However, the big reason for the jump in bund yields is that the region is adding a large spending plan that will trickle throughout Europe as the manufacturing heartland of the region. Opening the taps, Germany is negotiating plans to spend up to 200 billion in defense and 500 billion in infrastructure. That's a big reason why bunds are selling off. A lot of supply is potentially on its way, and the growth expectations are shifting. Now let's talk about growth. A European turnaround, that's a phrase we haven't heard much in recent years, but is it happening? Germany has struggled under the weight of high energy costs and weaker global manufacturing demand and pressure on automotive manufacturing to build out greater EV production where there remains uncertain demand and high cost pressures. But there are now early signs of stabilization. On Monday, the 10th of March, German industrial production numbers came out better than expected. Month-over-month production grew by 2%, better than the 1.5% expected. However, year-over-year remains negative, but much less negative than expected at only minus 1.6%. And factory orders are down year-over-year and month-over-month. Meanwhile, countries like Spain and Italy are holding up better thanks to services resilience, tourism, and stronger domestic demand. Italian GDP came out slightly higher than expected for the fourth quarter at 0.6%, and purchasing manager indicators came out positive in both countries. Germany's weakness was mainly in energy-intensive industries, while Spain and France had stronger output driven by consumer-facing goods. Now that Germany is spending its way to growth, Europe just needs France to get its act in order, as well as the UK. For now, the divergence within Europe is clear. Not all economies are moving at the same pace, but at least the trend is shifting in the right direction. However, government spending is not the answer to long-term growth, and prospective tariffs from the US still hold question marks on strong improvements to European growth in the year ahead. Nonetheless, things are at least starting to look better than they did at the beginning of the year. So, what's the trade here? If you believe in a European growth rebound, it could mean less room for ECB rate cuts, which aligns with the bond market sell-off narrative. It also raises the question, is European risk-taking back on the table? Investors may start reassessing allocations to European credit, equities, and rates. So far, European equities have been an outperformer this year. So, following on from that rising yield environment discussion, the other major market development is that European bond yields have now risen to a level that are surpassing equity dividend yields. For years, European investors faced a stark reality. Ultra-low bond yields meant there was no alternative to equities. And even though that was the case, it is not like European equities were going through the roof thanks to low growth. That's changing, and it's happening fast. Why are yields higher than dividends now? Higher for longer interest rates mean that government bonds and high-grade corporate debt now offer yields that look compelling compared to equities. This is positive for credit market investors, though there may not be much spread uplift from here. There has been some recent deterioration in the broader market sell-off in the past few days, and it does mean that overall yields are higher, making fixed income a more attractive investment opportunity. As one of the partners at 24 Asset Management recently wrote, keep calm and collect your carry. That could be the mantra for the year. This is a huge moment for bond investors. Investment-grade corporate bonds can now offer 5% area yields, and the Bloomberg Pan-European Aggregate Index is currently at 3.3%. And even some sovereign debt, previously yielding nothing, looks more attractive than equities on a risk-adjusted basis, with equity dividend yields of 3.1%. Fund flows indicate that money is moving back into fixed income strategies across Europe, both in public and private markets. However, as usual, the shift to bonds isn't uniform across the Eurozone. Corporate credit, especially in sectors like industrials and energy, is drawing interest as companies refinance at higher rates, but still maintain strong balance sheets. Also, as I mentioned last week, many company workouts are coming through. Though I will give you one example of why it is important to remain vigilant in your portfolios, and even geopolitics can impact upon performance. In Europe, the Starlink competition Eutelsat is a high-yield company that was facing many short sellers convinced that Starlink was going to pressure their revenues and margins. But recent activity has forced both the bonds and equity into a short squeeze, as many governments reconsider the use of Starlink and look to the alternative. Stay focused out there and be sure you pay attention to all the names in your portfolios. To wrap up, let's bring it all back to the topic of differentiation. That's been my central thesis for 2025 and is proving to be overly accurate. European markets are behaving somewhat differently from the US. The growth picture is still weaker than in America, but it's improving faster than expected, which explains the bond market repricing. Not all European economies are moving together. Southern Europe is still outpacing France and Germany for now, but France and Germany's, particularly Germany's industrial base, may be bottoming. Fixed income is taking center stage. The fact that bond yields have matched equity dividend yields is a major shift in Europe's investment landscape. So what should investors do? Watch the ECB and policymakers closely, track the growth divergence across Europe, and be sure to pay attention to credit quality and the names in your portfolio. That's all today. Thanks for tuning into the Credit Compass. Be sure to subscribe for more insights, and we'll speak to you all again soon. As always, staying informed is key to navigating these complexities. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.